Strong internal controls play a crucial role in keeping a small business stable and secure. They protect your assets, keep your financial records accurate, and reduce the risk of fraud or costly errors. While many owners assume these controls are only necessary for large companies, the truth is that small businesses need them just as much. Good controls create structure, clarity, and accountability in day-to-day operations. They also build trust among clients, employees, and potential investors by showing that your business takes financial management seriously. In this article, we'll break down why internal controls matter, how they support smoother operations, and the key steps you can take to set up a system that keeps your business running safely and efficiently. Why internal controls prevent financial fraud. Internal controls are one of the most important defenses a small business has against fraud and financial mismanagement. They keep your accounting processes transparent, reduce mistakes, and give you a dependable system for monitoring where your money goes. For many business owners, these controls feel like something only large companies need, but the truth is that smaller operations are often at higher risk because they have fewer people handling more responsibilities. Putting the right controls in place protects your assets and strengthens the financial backbone of your business. A major part of fraud prevention is separating key financial duties. No single person should be responsible for both approving and processing transactions. When responsibilities are shared, it becomes harder for errors or misuse to go unnoticed. This creates accountability and builds a healthier financial environment. Approval workflows bring another layer of protection. Requiring more than one person to sign off on large payments ensures oversight and creates a clear trail for future reference. These steps support accurate reporting and help keep you compliant with financial regulations. Cash flow oversight is essential as well. Monitoring inflows and outflows on a regular basis helps you spot red flags early. Reconciling internal records with bank statements is a simple habit that prevents small discrepancies from turning into major problems. Inventory controls protect product-based businesses from shrinkage and loss. Keeping track of stock levels and running routine audits helps you identify theft, errors, and waste long before they affect profit. Internal controls also rely on people, which makes training essential. When employees understand why controls matter and how they work, they're far more likely to follow them consistently. Training supports ethical behavior and creates a workplace where transparency is expected. Encouraging employees to report concerns without fear promotes honesty. Anonymous reporting options help uncover issues early and show staff that you take integrity seriously. Technology also plays a major role. Automated accounting systems flag unusual activity and reduce the risk of missed entries or duplicate payments. Tools such as automated invoicing, approval workflows, and real-time dashboards give owners stronger financial control. Accurate documentation ties everything together. Keeping organized records, from vendor contracts to expense reports, ensures your business has a solid audit trail. Even requiring key accounting staff to take vacations can reveal irregularities that might otherwise stay hidden. Strong internal controls give your business structure, safety, and confidence. With the right framework, training, and technology, you can protect your finances, support accountability, and build long-term stability. Steps to implement basic controls. Putting internal controls in place doesn't have to be complicated. The goal is to create a system that fits your business and protects your operations without slowing things down. That starts with identifying the areas where your business is most vulnerable. Every company has different risks depending on size, industry, and workflow, so understanding your specific pain points gives you a foundation for creating an effective plan. Clear policies make everything easier. Document simple, direct procedures for how you handle payments, collect receivables, process payroll, and reimburse expenses. When expectations are clearly defined, mistakes are reduced and employees know exactly how each task should be handled. Good documentation also makes onboarding smoother and keeps operations consistent even when staff changes. Employee training is a key part of successful implementation. Staff should understand the purpose of these controls and how they help protect the business. When employees see the value, they're more likely to follow procedures carefully and support compliance. Separating financial duties strengthens your system. No one person should have complete control over approving transactions, entering data, and reconciling accounts. Dividing these responsibilities prevents misuse and creates a built-in system of accountability. Ongoing review is just as important as setup. Regularly checking financial statements, reviewing bank reconciliations, and monitoring spending helps you catch potential issues early. Internal reviews or periodic audits help you assess whether your controls are still effective or if they need updating. Technology can make internal controls easier. Accounting software automates repetitive tasks, reduces errors, and provides real-time reporting. Automated reminders, approval tools, and digital records help you stay organized and maintain visibility over spending and cash flow. It's also wise to establish spending limits. Setting clear thresholds for purchases and requiring approval for higher amounts keeps your cash flow protected. Automated workflows can enforce these limits automatically. If you manage inventory, routine checks are essential. Verifying counts and comparing them to accounting records prevents losses and highlights areas that need attention. Protecting financial data is a final layer of control. Secure access, encrypted files, and proper storage practices keep your sensitive information safe from misuse or unauthorized access. With these steps in place, your small business gains a more dependable financial structure that supports accuracy, transparency, and long-term stability. Common mistakes in internal auditing. Internal audits play a critical role in evaluating whether your controls are working, but many businesses overlook key steps that make audits effective. One of the biggest mistakes is starting without proper preparation. Without a clear audit plan or checklist, important areas can be skipped, leaving weaknesses unaddressed. Another common issue is poor documentation. When financial records are incomplete or disorganized, auditors don't have enough information to accurately assess your controls. Keeping clean, consistent records, bank statements, receipts, contracts, and reports makes audits faster and more reliable. Many businesses also struggle with communication after an audit is completed. If findings aren't shared clearly, team members may not understand what needs to be corrected or improved. Transparent communication ensures everyone knows their responsibilities and allows corrective action to happen quickly. Another issue is failing to focus on high-risk areas. While it's important to review overall operations, some processes carry more risk than others. Cash handling, payroll, procurement, and inventory management should receive more attention because they're more vulnerable to errors or fraud. Inconsistent enforcement of policies creates another problem. If employees see that rules are only sometimes followed, compliance becomes weak. Strong internal controls depend on consistent application across all departments. Some businesses also fail to verify whether financial duties are properly separated. An effective audit should always check that no employee has authority over an entire transaction cycle. Overlooking this can leave the business exposed to significant risk. Finally, many internal auditors don't receive ongoing training. As financial regulations, accounting tools, and industry best practices evolve, auditors must stay updated. Without proper training, they may miss emerging risks or fail to recognize weaknesses in the control system. Avoiding these mistakes makes internal audits more effective and helps ensure your financial controls remain strong as your business grows. Technology tools that strengthen controls. Technology plays a major role in modern internal controls, helping small businesses reduce risk, improve accuracy, and stay organized. Using the right tools gives you better insight into your financial operations and helps prevent the kinds of errors or oversights that can lead to serious issues. Accounting software is one of the strongest tools available. Automated systems streamline tasks such as invoicing, data entry, and reconciliation. They provide consistent, accurate records and generate audit trails that show exactly how and when transactions were handled. Cloud-based accounting solutions take this a step further by allowing you to view financial data in real time. These systems also offer secure access, multi-factor authentication, and automatic backups, making them safer and more flexible than traditional methods. ERP platforms offer a broader solution by combining accounting, payroll, inventory, and procurement into a single environment. By centralizing information, ERP systems make it easier to monitor spending, track movement, and identify problems early. Data analytics tools help you identify unusual patterns across transactions. Spotting irregularities quickly allows you to take action before small issues turn into major financial problems. Secure payment processing systems also support stronger controls. These systems maintain detailed records, enforce approval levels, and restrict access to authorized users, reducing the risks of unauthorized spending. On the payroll side, employee management software causes fewer errors and limits misuse by automating calculations and maintaining accurate attendance data. Finally, cybersecurity tools are essential. Firewalls, antivirus programs, and monitoring software protect financial systems from data breaches and cyber threats, which are increasingly common for small businesses. Using these tools helps build a more reliable and efficient control environment, giving your business a stronger footing for long-term financial health. If this video helped you understand accounting a little better, don't forget to like, share, subscribe, and turn on notifications for more accounting tips and guides.